Hey, this is 1001 Investing Channel. We are here with tips and secrets about investing. So please pay attention to this audio. Trading price action instead of fundamentals. When I got into the business, there was so little information on fundamentals, and what little information one could get was largely imperfect. We learned just to go with the chart. Why work when Mr. Market can do it for you? Paul Tudor Jones. Fundamental analysis is the examination of the underlying forces that affect the well-being of the economy, industry groups, and companies. As with most analysis, the goal is to derive a forecast and profit from future price movements. Definition courtesy of stockcharts.com. Technical analysis is the examination of current and past behavior of participants that are buying and selling a particular financial market based on price action. The goal of technical analysis is to find patterns in price action that are profitable. More than 20 years ago, my father-in-law bought a used truck that he wanted to flip for a quick profit. He looked at the mileage on the odometer, the condition, the make, model, age, and the fact that it was a stick shift, and decided on a price based on all these factors. I thought his price was high because there were plenty of used trucks in the world and not a lot of buyers looking for this particular type. He asked me what I thought the value of the truck was. I thought about it and told him I thought the value of the truck was exactly what he could get someone to pay for it. The value would be established as offers to buy the truck came in, versus his initial sell price. The suggested value for the truck he would find in books was only a fundamental valuation. The publisher of Kelley Blue Book was not offering to buy the truck, they were giving him a value guideline. The true value would be set by the first person with cash offering to buy his truck. Values are based on buyers and sellers and not opinions or fundamental valuations. Prices can move so far away from fundamentals that they are useless. Needless to say, my thoughts about technical price action versus the belief of value didn't go over great with my former drill sergeant father-in-law. He was not impressed that I would question his wisdom on buying a depreciating asset as an investment. But he is not unlike the millions of fundamentalist investors in financial markets who get angry when price doesn't align with their belief about value. Similarly, fundamentalist investors that buy companies based on what they should be worth but can't make money off their investment portfolio during bear markets and downtrends, can become easily frustrated because they have placed their trust in the belief of value. This book is about trading price action instead of investing in a company based on its balance sheet and stock price versus book value. The concepts in this book will show you how to create actual trading plans for buying high probability setups, trading on the right side of a trend, and exiting with a profit without having to look at fundamental valuations. This is a book for traders that want to profit from price action and not for investors wanting to buy a company that is undervalued in the hope that one day the true value will be priced in. There are trading systems that incorporate fundamental valuations like price-to-earnings ratios, return on equity, sales growth, and other metrics that create their watch lists based on fundamentals, but still trade based on technical price action, a trading system, or chart patterns. Even if you can find the best value stocks or growth stocks to trade, you will only profit if you buy them and sell them at the right time. Let price guide your decisions on buying and selling? Inside the investing world, this will seem like blasphemy. Regardless of what anyone believes a company is worth, the company and the stock are two different things. A company is a corporate entity with a profit and loss statement that is charged with making profits for shareholders and making Wall Street happy by beating earnings. Businesses must create earnings by selling goods to customers in an efficient and cost-effective way that makes money. Corporate profits end up on the company's balance sheet, which can be used to reinvest in the company through capital expenditures, or to pay a dividend to company shareholders. The company's stock is altogether different, because it trades on an exchange and buyers and sellers determine the price of that stock and what they are willing to pay. In my experience, very little buying and selling is based purely on fundamental valuations. Most market action is based on a trader or investor's emotions. Every buyer and seller has a different motivation for buying or selling. The only rational reason to buy a stock is because you think that the stock is going to go up in price and you will make money. Even when short sellers buy a stock back to cover their short position, it is because they want to lock in their profits before the stock goes higher. While there is only one reason to buy a stock, people will sell a stock for many different reasons. They need the cash. They see a better investment or trade. They are fearful that the price will go down. A mutual fund manager has to sell holdings to raise cash. They believe the future of the company is in peril. They are fearful about the economy. They believe a new technology will disrupt the company. Something on the daily news. A rumor that is causing the stock to drop. They are nearing retirement and changing their portfolio balance. They are rebalancing their portfolio by selling positions that have gotten too large. The shares are inherited and the heirs prefer cash. All of these reasons for selling play out every day. None of them required a balance sheet or a price-to-earnings ratio. The markets are largely driven off the decisions of the asset holders rather than fundamental valuations. The buyers and sellers on stock exchanges can be value investors, high-frequency traders, trend followers, day traders, swing traders, growth investors, mutual fund managers, or hedge fund managers. All market participants have one motivation: to make money. Always remember, while there are many reasons to sell a stock, there is only one rational reason to buy a stock, because the buyer believes it will go up in value and they can sell it for a profit in the future. The future can be different things to different people. For Warren Buffett, the future may be in never, and for a day trader it could be in 30 minutes. The only thing that makes stock market participants money is exiting a position with a profit after price moves in their favor. Stock prices are driven by the specific supply and demand of their stock, not by the underlying company's results. It's the perception of the company's current and future results that interests buyers and sellers. A company's stock price has to go through the filter of all the market participants' perceptions, opinions, and predictions about what the current price should be versus what the future price may be. Fundamental analysis is a long-term game that can last for years. Warren Buffett's success as the greatest investor of all time is not based on simple fundamental value investing. The real key to Buffett's incontrovertible record is based on his ability to create the best margin of safety on his purchases. By picking the right ones the majority of the time, holding a concentrated portfolio of only his best picks, with an unlimited holding period, he has compounded his returns for decades. One of the keys to his success was acquiring the textile company, Berkshire Hathaway. Initially an aging business model, Buffett converted it into a successful insurance holding company whose insurance premiums could be used to acquire healthy companies with great cash flow, and those with moats around their business models that make it difficult for industry competition. His patience is legendary, often waiting years for a desired price. His buy signals are often triggered by extreme fear, when stock is available at a large discount. This value ratio creates a margin of safety that limits the downside risk even if he's wrong. His risk-reward ratio offers a significant gain if he's right, and the stock returns to a price that better reflects an accurate fundamental valuation of the company. Warren Buffett rarely sells, but he will exit his holdings when the business conditions are no longer favorable and there is little upside. Very few people will have the patience, discipline, genius, and luck to be anything like Warren Buffett. However, most people can trade simple price action trading systems on a comfortable time frame. If they use position sizing correctly, they can handle the emotional issues that hinder the majority of other traders and investors. Fundamentalists can suffer from long losing streaks. Investors tend to have larger drawdowns in capital and can give back years of returns very quickly during bear markets and financial crises. A good trader will have tight controls over losses, risk exposure, and drawdowns in their capital. Conservative buy-and-hold investors have dealt more pain over the past 15 years than most traders experienced with the 2000-2002 bear market and the 2008-2009 financial crises. Traditional buy-and-hold investors focused on retirement generally set their buy signals for every payday, resulting in a new contribution into their retirement account. Young buy-and-hold investors not worried about their retirement accounts look for buy signals all day, every day. Buy-and-holder investors generally sell when they are rebalancing their portfolios once a quarter, or annually when they sell their winning positions to use the capital to buy positions that haven't kept up, like bonds or other equity sectors. Another time that they will start selling positions is when they get closer to retirement, as they start to move their portfolios from stocks into lower risk and more stable bonds. Buy-and-holders expose themselves to unlimited risk with no stops because their investing system is based in the belief that stocks will have good returns the majority of the time over a 10-year period. This system seems to be more for the benefit of the mutual fund industry than investors. A little later in this book, we will explore some simple trend-following systems that easily outperform buy-and-hold investing with half the drawdowns. A poignant example of the disconnect between fundamental valuations and stock prices is the internet bubble of 1999 and 2000, before the price plunge of the tech sector brought it back into balance. The Nasdaq 5000 was an irrational price trend based on the idea that the internet would change the world and commerce overnight. The internet has changed the world, but prices were about 15 years ahead of the fundamentals in even the best technology companies. Most of the dot-com companies were worthless, but they made millionaires out of traders that traded them based strictly off price action, exiting with their profits when prices peaked. Another excellent example of a complete disconnect between fundamentals and price action was the market meltdown of 2008-2009. Was Ford Motor Company really worth $1? If Ford was worth $1 fundamentally and then went up to almost $19, did the balance sheet reflect this? I was warning friends not to buy Ford all the way from the $9 price level as it kept falling. I didn't examine the balance sheet, but I could see that the chart was in a downtrend, and it was obvious that investors and traders were pricing in a possible bankruptcy of Ford. Was Citigroup really fundamentally valued at 97 cents in March 2009? Can investors price in government bailouts with their fundamentals? A price action trader would have used signals to exit before Lehman Brothers, Bear Stearns, and the whole financial sector started melting down. Most fundamental investors lost a lot of money in 2008 and 2009, with no exit strategy from individual stocks or the stock market, and could only watch as a decade of gains disappeared. I have several problems with fundamental investing. When these investors buy something based on the belief of what it should be worth, it looks even better when the price goes lower and lower. It's also difficult for fundamental investors to know when to exit with a profit. While buy-and-hold investors in 2015 feel pretty good about themselves for holding through 2008-2009 and getting back to even, those that had sizable accounts from a lifetime of compounding didn't feel so good when they were down 50% of their portfolio in March of 2009 and ready for retirement. A good trader controlling their risk and position sizing will rarely have to suffer through drawdowns that investors take during corrections and bear markets. As traders, we have exit signals that limit our losses. I had a profitable year in 2008 by following price action. A 50% drawdown in a brokerage account will discourage most people from wanting to trade or invest again. This kind of financial, mental, and emotional pain should be avoided at all cost. While there are many legendary fundamental investors and fund managers that have found success, there are also wealthy technicians that simply and systematically trade price action. I think that the greatest opportunity for retail traders and small investors is to let the big investors and other market participants place their bets, analyze what they are doing, and follow along. I have been doing this in some form or another in my personal accounts for over 20 years, and it works. You don't have to predict the trend, you just have to find ways to ride the wave in the right direction. There are systematic ways to create buy and sell signals to outperform the market's returns. Even a simple trend filter can dramatically reduce your losses during corrections and bear markets. Regardless of how active you want to be in the stock market, this book can help you. Even fundamentalist investors would do better if they let the fundamentals tell them what to buy, and allow the price action and chart to tell them when to get in and when to get out.
Thanks for watching. I will upload a video every day with tips and solutions. So, for more, please like it and subscribe. It's free. Bye-bye.